Welcome to the Fintech Founder Journey, where we explore great fintech products, great fintech businesses, and great fintech leaders. I'm your host, Mike Scott, and I'm also the co-founder and CEO of Nona Digital, an expert firm that accelerates product development for fintech and blockchain scaleups. In today's show, I'm joined again by Ran Neuner, and we're going to be talking about crypto and Web3 in the context of fintech in 2022. Today's episode is sponsored by ourselves, Nona Digital. Working with us to create or accelerate your fintech product means you get access to our expert product squads that cover UI and UX, product ownership and architecture, and of course, engineering. And that have been building products together for a very long time. You get the benefit of a 40-person studio that is big enough for no key person dependencies to exist, but small enough so that you're always close to one of the principals. And you get the benefit of our reusable component library, which means we're often able to build your product faster than anyone else could at a comparable standard. As one of our clients once said, Nona is the type of business that paints the back of the wardrobe, because if you want to be the best, that's the sort of thing that you do. To get in touch with one of our principals or myself, head over to nona.digital to book a call directly. And now, onto the show. I'm joined again today by Ran Neuner, who's the host of Crypto Banter, one of the biggest crypto YouTube channels in the world, if not the biggest. They have grown to just under 540,000 subscribers. And just to give you context, when I had him on the show in August last year, he was on 326,000. So this growth is crazy. He's essentially trying to become the Bloomberg of crypto, putting out tons and tons of content every single day on YouTube, podcasts, now in a written version. It's really quite prolific. I think one of the main differences with Ran and why I follow him pretty dedicatedly is before he got into crypto, he was a massively successful entrepreneur, starting and scaling one of the biggest agencies in Africa, which I think he actually sold as the biggest deal of its type in Africa when they exited that business. So he's got proper business chops and is really comes at this with an interesting view. Today's show is not going to be the typical founder journey podcast and story, but more about what we might expect to see in the Web3 and crypto space for the year ahead as it might relate to fintech. So we'll try to keep the jargon to a minimum, but if you hear terms that you don't understand or recognize, just Google them, and you'll likely go down a rabbit hole that will, at a minimum, be pretty interesting. Before I welcome Ran, I just want to be very, very clear that nothing on this show is financial advice. Neither myself nor Ran are financial advisors. And it needs to be said that anything in this space is very, very risky, so approach with caution. With that said, welcome back, Ran. Thanks for making the time. Good to see you.
Good to see you again, my friend.
Cool. So look, let's start with the kind of obvious. Anyone in crypto or even not in crypto is conscious that there's a massive correction that's happening or has happened, hopefully. And really, this always gets me super interested. I don't know why. When these corrections happen, I start paying real attention to the businesses and the people that are sticking around and the sentiment, and it kind of separates the nonsense from the reality, I think. What I want to ask you, though, is just talk us through why you think we might be experiencing such an enormous correction. What do you think the drivers of this are at a macro level?
So typical market cycles are, the market cycles usually go from overbought to oversold, and then again from overbought to oversold. If you think about a market cycle, a market doesn't really go up in a straight line. A market kind of follows a trajectory, but it keeps oscillating between overbought and oversold and overbought and oversold. Now, if you think about where we were last year, there's no doubt that we were completely overbought. You think about what we did last year. You had projects doing 100x and even 1,000x. You had, the market went from, I think, it 10x'd itself in the span of 18 months. The stock markets also. I mean, the stock markets, if you take the bottom of the COVID correction and you look up, the stock markets also had incredible returns. So you're in a position where the markets were completely overbought, and it was overbought around this narrative of there's so much money in the economy because the Fed printed money, because of quantitative easing, because of the Fed increasing its balance sheet, et cetera, et cetera. And now what's happened is you got talk that this quantitative easing may stop, and the Fed may actually start taking money out the economy, so it may become quantitative tightening, what they call it. And you're talking about, instead of interest rates going down to zero, the Fed is threatening that because of inflation in the United States, which has hit unprecedented levels of about 7%, that they're going to have to slow down the economy slightly. When the Fed slows down the economy, they've got effectively three tools. The first tool is they can increase interest rates. Increasing interest rates makes money more expensive, makes spending much more expensive, and therefore people spend less. The second thing they can do is they can actually take money out of the economy. So they used to put money into the economy by buying corporate debt. And now what they can do is just take it out by selling the corporate debt and putting the money back and taking the money out of circulation in the economy. And the third tool that the Fed has is talk. They can just talk and talk the market down. And that's exactly what they've been doing. And they're doing all of these things to get inflation under control. So if you think about what the Fed's mandate is, the Fed's mandate is to balance inflation with employment. Make sure that the economy is growing fast enough to keep everybody employed, but make sure that costs aren't getting too expensive. And they've lost control of inflation. And they want to show that they now have control of inflation. And so for a while, what it's done is it's made the market, in our opinion, completely oversold. And you can see signs of oversold. You can see when you get big candles, big price movements to the downside, that's a sign of oversold. When you get quick recoveries, like we've had in the last couple of days, it's a sign of people rushing in to buy the market because they're saying, look, it's so cheap now. There's panic. Also, the market's gone down. Bitcoin's gone down pretty much in a straight line, about 50% from its highs. You know, you kind of look at those kind of things and you say, hold on a second. If I take the underlying technology and I take the adoption of this technology, and then I say this asset class, which is possibly the fastest growing asset class in terms of adoption in the world today, and it's gone down, it's corrected 50%. I don't know, it kind of feels cheap to me. And that's why we've actually gone full risk on and we've started buying again.
So tell me, Ran, I mean, that's really cool and really helpful and makes a lot of sense. What I'm trying to think about, though, when I hear this is, you know, if you're a crypto investor, you're worried about the prices of things. But what do you think, or maybe you know this, I know you advise a lot of projects, but so a DeFi project, a crypto project at the moment, this is happening, the people that hold those tokens, they're being affected by it. But how does this affect the actual companies building things in the space? They'll obviously have a bunch of tokens. Those tokens are worth X dollars, and then this happens and they're worth X minus Y percentage dollars. But in terms of the guys that are actually building stuff, how do they respond to these sort of things? So I'm not talking about the investors. I'm not talking about the traders. I'm talking about the guys that are building the protocols, that are building the layer 2 protocols, that are building things that are utilizing this stuff. What are they doing in times like this? I know you have a very good eye to a lot of these leaders. I know that you actually advise a lot of these leaders. What do they do at times like this, the guys that are building stuff? So
I'd say there's two classes of people that are building at the moment. There's those that have raised capital, and then there are those that are yet to raise capital. Obviously, before this market correction, it was very, very, very easy to get capital. We were in a capital disequilibrium. And when I say a disequilibrium, the way I see the world, projects should fight for capital. So in other words, there should be more projects and less capital, and projects should pitch for capital. And I don't know, that's just the way that I feel that an equilibrium needs to happen. We were in a position where capital was fighting to get into projects. So we were in a position where you wanted to invest in a project, and the project basically said to you, look, no, we're full. Or I know you want to give me 100 grand, but I can only accept 20. And that was happening with every single project. And it was happening super, super quickly. So like rounds of $5-10 million were being filled up in 45 minutes. And no one was doing any kind of due diligence. So you now have a whole lot of projects who've raised capital. And then you've got a whole lot of projects who now really need to raise capital. For the ones that have raised capital, they continue to build. They are, in my mind, overfinanced. Majority of them are overfinanced because, you know, they raise too much capital too quickly. And generally, projects that are overfinanced tend to be a little bit negligent with their money. The worst thing that you can do to a project is drown it in capital, because they start to fix problems with money as opposed to with actual solutions. That's a very common problem. Then you've got the projects who are trying to raise money now, and they're having a much, much, much harder time to raise money. But I guess we're just in a more realistic world now. And it means that people have to work harder. They have to be smarter to raise capital. And I know this is probably a little bit controversial, but I actually prefer bear markets. I prefer bear markets. And I'll tell you why I prefer these bear markets. One is, you've got much more time to research projects because you don't have FOMO, because projects aren't raising money every 10 minutes. So you've got much more time to research projects. You've got much more serious founders that you're dealing with, because in a bull market, when money flies around, you get a bunch of schlenters who know nothing and have pretty PowerPoint presentations being able to raise money. You compare that to a bear market, those guys don't get through the first round. And so the people that you actually start dealing with are good people. The third reason why I like bear markets is because valuations. In a bull market, like we had, the guy's got a PowerPoint presentation. He's got the word metaverse in the PowerPoint presentation 3 times. He's got the word NFT in the presentation 5 times. And therefore, he can raise an valuation of $100 million. And then, like now, in the bear market, that $100 million project is probably valued at $10 million because it's just much harder to raise capital. So I think that life-changing returns, or what we call on the show, wife-changing returns are made in the bear market, not in the bull market.
I mean, everything you're saying there makes a lot of sense, Ran. It comes back to what you said right at the beginning, which is like, you know, when there's too many projects and not enough capital, it's better because it sifts through. There's a scarcity that makes the best bubble up to the top, and I guess in crypto, we just see that happening much, much quicker. You know, I would argue that in the fintech space, the valuations are crazy as well. You know, there's fintechs raising off 100 times revenue that are never going to see it. So it seems like a bit of a bubbly market altogether.
You know,
I want to jump into DeFi.
I've thought about this in the context of crypto gaming. And the reason why I thought about it in the context of crypto gaming is because one could argue that there aren't any very successful crypto gaming platforms. I mean, I guess the most successful crypto game today is Axie Infinity, which I think is a great game. But I think when you compare Axie Infinity to like normal video games, I think you can't really compare it. Like Axie Infinity is probably here, and normal non-crypto games are over here. But the market is giving Axie Infinity a valuation which is probably higher than most real life games. Okay, which is like and it's not only Axie Infinity. There are probably 100 crypto games, or maybe even 1,000 crypto games that are trading at valuations that are bigger than their non-crypto most successful counterparts. So I spent a lot of time thinking about why is this happening? And initially what I thought is that the market, I actually tweeted something else. I said, the market is valuing all these crypto games as if they've all already succeeded. And we know that only 1 out of 1,000 will succeed. But the market is valuing 1,000 out of 1,000 as if they have succeeded. So what's the psyche there? Why is that happening? Because the market, each investor is betting on a game as if it has succeeded without actually taking the probability of success. So every game is now priced to the maximum. And then investors are saying, look, my bet is that this is going to go to the maximum. And if that's my bet, then because there's such a big market of investors, they're pricing every game to success. And that's the same as fintech. In fintech, they're saying, look, they're pricing every protocol as if it has already succeeded. So the bet that you're taking is that the protocol will definitely succeed, and you're getting incremental upside, which for me is a stupid bet.
Yeah, totally. It's crazy to watch, and then I mean you get these big corrections, and it makes a lot of sense, right? And we'll get to the play to earn gaming stuff a little later. I want to talk about DeFi for a second. So there's quite a cool meme going around. I'm sure you've seen it 100 times. You know, fintech in the front, DeFi in the back, which I actually think is pretty cool. Like the way that it explains it to people. So what do you see playing out in 2022 in the DeFi meets fintech space? You know, do you think there's going to be mass adoption this year already with, let's call them traditional fintechs? I'm not talking about financial institutions. I'm talking about fintechs, at least one step, further than financial institutions. But do you think we're going to see widespread adoption of fintechs that we're now used to and comfortable with on the back end, utilizing DeFi to do stuff? Generally going to be yield, right? But how do you see DeFi in the context of fintech playing out in 2022?
So no, I don't. I think we wrote a article on our website, cryptobanter.com, where we identified 6 of the biggest trends for 2022. One of the trends that we spoke about was what we called institutional DeFi, which is, I think, what you're calling FinTech meets DeFi. It's much more complicated than you think. And I'll explain to you why it's much more complicated than you think. I'll give you a very, very, very basic solution, a very, very, very basic problem that right now doesn't have that many solutions. Who allows who processes or authorizes the transaction? So you want to stake $100 million to get the yield. Who authorizes the transaction? Is it the trader on the floor? Who's the guy that actually signs the transaction and transfers the money? And that's a problem because you need multiple signatures to approve. You need multiple signatures. Now, that functionality, multi-sig, what they call on Ethereum, doesn't actually exist yet. So that's just giving you one example, or doesn't exist properly yet. And so there are hacks to the system, which we call multi-party computation, which basically allows for a private key to get sharded into pieces. And then you need 2 of, or X of Y to sign the transaction before it becomes a transaction. But that's just one of the issues. The second thing is, as a multi-billion-dollar pension fund who wants to put $100 million into DeFi, how could you possibly put it into DeFi when there's no insurance? And there's no insurance today in DeFi that can insure you for $100 million against tax. It doesn't exist. The protocols just aren't mature enough. And so I think that 2022 is going to be the year where we build the building blocks to be able to allow big capital to start playing DeFi. And I think it'll probably be a 2023 or 2024 thing where big capital comes to DeFi. We would love to have them in DeFi now, but right now it's just not a reality. The rails don't exist for real capital to actually enter.
So that's super interesting, Ran. And I mean, I do follow a lot of your content, and I know you're quite excited about a project. I think it's called Credo, and I think Credo is trying to solve for one of those problems, which is the multi-sig situation, if I recall correctly. But like you say, it's very early. It's not done. It's not tested. It's not proven. The other thing that you speak a lot about is a protocol called Anchor. And Anchor protocol is just for the user's benefit. Ran, you can correct me if I get any of this wrong. But basically, you lock up a stable coin. The stable coin is linked to the US dollar, but it's an algorithmic stable coin, which means it's not collateralized. And once you put the stable coin into the Anchor protocol, you lock it up, although it's freely available as soon as you unstake it. And it gives about a 20% return. Now, if I've missed anything there, feel free to correct me. But basically, the question here is, how is it possible?
How sustainable is the 20% from now and until the end of time?
There you go. It's the question, right? It's the question. So hit me with the answer that you've clearly given to tons of people. So go.
It's a very technical explanation. I don't think it's something that we can cover fully on this podcast. But there is a mechanism by which the deposits that they take earn money. So they take deposits of Luna. Luna earns a yield of XY, I think it's like 7.5%. Plus, when people borrow the money, they get a return on borrowing the money. And the mathematics works out in such a way that it is that it actually is to a greater or lesser degree sustainable. At the same time, they have any money that they make over and above goes into a pool, which is there to cover for the periods when there's a misbalance between the deposits and the loans that are taken out. So to a greater or lesser degree, Anchor is actually sustainable. It's about a half an hour explanation, and I'll send you a YouTube link which you can post at the bottom of this podcast, which actually explains exactly how it works and exactly how it's sustainable.
That'd be awesome, because I went to look at this and I actually couldn't find a satisfactory answer. The closest I could get was a portion of this is covered by the other side of the lending borrowing equation, but it's only about 8% out of the 20. So I'm really keen to know where that other 12% comes from. And I guess just to the listeners, just, if anyone's really interested in this, the risk, as I understand it, with something like the Anchor protocol, I don't want to pick on Anchor because they're actually pretty great, but the risk is that the stable coin that's underpinning the whole thing loses its algorithmic peg. And I'm not even going to hazard a guess on how to explain that completely, but that's actually the risk. So there are risks here. But it feels to me like the risk is less around the return dropping and more around the stablecoin losing its peg. But it seems to have done very well over a few pretty turbulent times. So go ahead and tell us more about that.
There are effectively three types of digital money. If you think about digital money, there are three types of digital money. One digital money is money that is collateralized by fiat. So if you think about USDT and USDC, what they are is you get one USDT and it is collateralized by $1 of US dollars in a bank account somewhere. That's theoretically what happens. The truth is that it's actually not exactly one-to-one back, because they take those US dollars and they invest it into corporate debt and. But for simplicity, the one kind of digital money is dollars that are backed by US dollars. The second type of digital money is dollars that are backed by assets. And in some cases, or in most cases, they're crypto assets. So let me give you an example. You have Bitcoin. You give me your Bitcoin. So let's say your Bitcoin is worth $35,000 today. You give me the Bitcoin. I then give you magic digital money, which is equal to 50% of your Bitcoin. So you give me a Bitcoin that's worth 35 grand. I give you 17.5 grand of magic money, magic digital money. And if the price of Bitcoin remains over 35 grand, there's no problem. If it goes anywhere near the amount that I've given you, I liquidate the Bitcoin for US dollars, and then I'm never out of pocket. So we call that collateralized stablecoins. Okay, now usually those are over collateralized stablecoins. So they always have more collateral because of fluctuations in the market. That's a second type of digital money. And that kind of digital money can be collateralized by anything. You can collateralize it by gold. You can collateralize it with property. We collateralize it with crypto because it's liquid. So it's like, selling a property, it sounds hard. Mm-hmm. So you got money that's backed by dollars and money that's backed by other assets. If you think about the money that's backed by dollars, the US dollar is a piece of shit currency. It's actually worth garbage. It's not backed by anything. It's backed by a huge debt that the US economy can never actually ever pay. It's just a trust system.
Yeah.
The third kind of money is algorithmic money. And in that algorithmic money, they call it seigniorage money or algorithmic money. It is backed by nothing except an equation, a game theory equation. So in the case of Luna, you've got Luna, which is a protocol that issues Terra. Terra is US dollar pegged money, 1 UST. For every UST that is created, $1 of Luna gets destroyed, making Luna more scarce. Okay, so if I want to create 100,000 UST, I have to burn 100,000 Luna. And there's a relationship between Luna and Terra which algorithmically keep it at 1. So if the peg goes below 1, people buy it and they say, hold on, if I'm buying something at 99 cents, I'm going to be able to sell it at $1. So they buy it. And if it goes above, then they sell it. And it's an algorithmically backed stablecoin. Now, if you compare money number 1 to money number 3, money number 1 is backed by US dollars. The US dollars are actually worth garbage. The Fed prints US dollars as much as they want. The US can never repay its debt. And then money number 3 is backed by a mathematical algorithm, which is completely predictable because it's hard-coded. And then you kind of ask yourself, well, which one makes more sense? The one where the US government can keep printing more and more and more and is actually really backed by nothing? Or the one that is algorithmically pegged and we all know what the rules are and the rules can never be modified? Now,
so how does something like UST, which is the Terra version of a stablecoin, how might it lose its peg? Is it basically just an error in the smart contract? Is it an error in the code? Is that how it loses its peg? Or is it market manipulation where, people, as you said, it drops to 99 cents, people buy it, it goes above, people sell it? How might it lose its peg? Like, how does that actually happen?
Okay, I'll give an example. If all of a sudden there is zero demand for Terra, and let me give you an example. If all governments in the world say, we are banning the use of Terra in our country all at once, just as an example, extreme example, everybody's going to want to sell their Terra. There's going to be no buyers, right?
Yeah.
Then the peg which now pegged 1-to-1 to the dollar, will drop. And it'll drop to nothing, 20 cents, 5 cents. It's lost its peg. And there's no one who's going to back it. There's no one who's going to buy it back. And then it loses its peg. Technological failure. If somehow the protocol fails, now this protocol has been battle tested for a year or 2 years, but hey, I don't know. Maybe there's a way that will destroy the technology. So the biggest risk with algorithmic stablecoins, of which Terra is the best, I think there's about $12 billion worth of UST in circulation today, is that it loses its peg. And to that end, if it does, I think it'll be like the collapse of a $37 billion business, because both Terra and Luna would then lose their value. And so it would be a collapse of a $37 billion business. That's quite a big, that's 10% of Evergrande. That's quite big. Like, just think about what that would mean for the world economy.
Yeah, no, it's super interesting, but I want to move on a bit because we're getting a little bit too deep. I'm super interested. I don't know how much the listeners will want to go further than that, but that was a really great explanation. It's helped me understand some of that quite a lot. Thank you. I want to move to NFTs, and what I want to talk about with NFTs is I had a really cool founder on. We haven't released the show yet, but I interviewed him last week. The founder of NFTfi. They're doing collateralized lending against NFTs. Pretty cool. They're growing, 80. No, his name's Stephen Young.
Okay.
And they're growing 80% month on month. It's a real business. It's a for-profit business. Very cool guy, very smart guy. And we were talking right in the middle of this correction, and I said to him, as someone building in the Web3 space, like, how are you thinking about this? And he said, it's interesting, Mike. NFTs seem to be sort of separated out from the general crypto world, and then he said about how his business is still growing. And then I think a day later, OpenSea sort of released some of their numbers, and, they've just sort of done over $4 billion worth of transactions. They're just growing. And I started just scratching around a little bit, and it does seem a bit as if the NFT world is slightly kind of protected from the broader crypto world. I don't have huge amounts of data for that, but just after scratching for an hour, it did kind of look like that. The floor prices had gone up on some things that I'd looked at. On the whole, it felt as if the NFT world was kind of separated from this crypto crash, especially the guys who are building infrastructure, right? So I'm not talking about necessarily artists minting NFTs. Steven's building some pretty great infrastructure stuff for the NFT space. He's not actually doing anything to do with actual NFTs. He's providing a marketplace. What's your view on this. NFTs and do you think they're sort of slightly decoupled? Do you think they're protected? Just where's your head at when I say all that stuff to you?
So be careful not to mix up pricing and market sentiment with actual adoption of underlying businesses. Okay, so just because the prices have gone down over the last 3 weeks doesn't mean that the protocols or the businesses have started to do better or worse. The protocols and the businesses are on a trajectory, and if you lift up the hood, you'll realize that there's more active Bitcoin addresses now than there've ever been, despite the fact that the price is going down. Okay, so don't mistake short-term fluctuations in price with what's actually happening under the hood. Now, what is actually happening under the hood? We've had an NFT explosion. So NFTs, in my mind, are, I would say, possibly the most exciting business phenomena that's ever happened to the world. Okay, now I know that's a big statement, but if you think about what NFTs, what they are, all the different use cases, and what's happened in a period of 12 months. So 12 months ago, if I would have spoken to you about NFTs, we both would have said, there's one NFT project, it's called CryptoKitties. It was a failure from 2017. It crashed the Ethereum network, and we've never heard about NFTs since then. That's what the majority of people would have said. 12 months later, every sports team has an NFT. Every sports player has a collection of NFTs. Melania Trump has launched or is launching a collection of NFTs. There's NFT, there's metaverses. Facebook has changed their name to Metaverse. Twitter has integrated NFTs into their profile pics. Instagram has come out and said that you can buy and sell NFTs. This all happened in 12 months. You name one other business phenomena in the entire world that has spread as quickly as NFTs have taken off. There's never been that. I've researched this. Has there ever been any piece of software or any business with adoption as fast as NFTs? The answer is no, which to me says that it is the most exciting industry today in the world, to me, is NFTs because of how fast it's growing. Remember, with tech companies, the valuation metrics are how quickly are you growing? How fast are you getting to your million or 10 million or 100 million users? That's the metric by which social media companies are measured. Now, apply that metric to NFTs. There's never been a technology or a phenomenon in the world that has spread as fast as NFTs have spread to the entire world. Just doesn't exist, never existed. So it doesn't surprise me that they say that their business is booming, because forget about the prices. The prices are investor speculation at a point in time. Crypto prices are currently being depressed by Jerome Powell and whether or not there's going to be quantitative easing. Let me tell you something. Whether he increases interest rates by 25 basis points or 50 basis points, or whether he starts in January or whether he starts in March, makes absolutely no difference to the fact that people are going to keep buying beautiful JPEGs at millions of dollars that actually have functionality. And so I think we've just started with NFTs. I think it is the most exciting, fastest growing phenomena and industry in the world today. And it doesn't surprise me that any company in NFTs is doing phenomenally well. In terms of pricing, I'm not sure that they've escaped this market collapse. I looked at my NFT gaming portfolio. To be honest, it crashed just as hard as the rest of my crypto portfolio. If my protocols were down 50%, my games were down 60%. And that's because they probably, in the recovery, are going to recover much quicker. But don't mistake that for a lack of progress on NFTs. NFTs, for me, most exciting industry in the world.
And I think that, I mean, there's so much in what you said there, Ran, but it's what I see is that the guys that are building actual infrastructure, the guys that are building the plumbing, the infrastructure, the rails, the marketplaces, they're just building gargantuan businesses for the future. They're going to be absolutely enormous, and there's going to be many of them. And we're not going to get into layer ones and layer twos today. For the listeners, you can research that if you want. Ran loves to talk about that stuff, so I won't let him because otherwise we'll run out of time. But it's kind of the backbone of everything we're speaking about here. Just quickly, I want to touch on play to earn quickly. So crypto gaming, you've spoken a lot about it already. I have a strange question for you though. Just humor me here. Do you see fintech apps or institutional money ever getting into using the play to earn stuff to generate returns on the back end? You know, it's still return generating stuff. It's still guys putting in money, putting in investments, getting passive income through renting out their peg axes or whatever it is that they're playing. Do you ever see like a convergence? I know it's a bit of an odd question, but like a convergence between like fintech on the front end or institutional on the front end, and then tell me what you think. Yeah. Okay,
so my kids spend hours and hours and hours and hours and hours playing Minecraft. Like that's what they do. And when they're not playing Minecraft, they're watching other kids play Minecraft. They watch on the iPad, but they're watching someone else play a Minecraft game. Yeah. Which is dead time. Yeah. I mean, I know they're learning. Minecraft is a great way of learning, but it's dead time. That's going to migrate to play to earn, and then my kids are going to start earning a lot of cash playing games. So let's start with that as a premise. Now, the reason, or one of the biggest reasons why DeFi will murder traditional banking is not because we're going to start holding our own keys and we've got control of our money and the returns are much bigger. That's not why DeFi is going to start. Those are some of the reasons. The main reason why DeFi is going to murder banking is because DeFi is fun. Because the banks missed the trick in terms of making money fun. Okay, now there's a great protocol which is called DeFi Kingdoms. DeFi Kingdoms is a protocol.
It's on the Harmony blockchain, I think.
It's built on Harmony. Right? It's built on Harmony One. It's built on the Harmony blockchain. Yeah. It's valued at a couple of $1 billion. But what is it? It's effectively a game which allows you to earn huge yields on your money. So what they did was they made managing money fun. So it's play to earn, but for work. So it's almost like you imagine a world in the future where money managers actually, listen, I was a money manager. I used to go to work. Going to work in a suit and tie and following corporate procedures and putting in buy and sell orders was the most boring fucking job in the whole world. Okay, it's just boring as fuck. So I don't know if I'm allowed to swear on your podcast.
Yeah, totally, it's fine.
But let me tell you, when you play Axie and you start earning money, when you play DeFi Kingdoms and you start earning money, millions of dollars, and it's actually fun. It's like a riddle and it's super fun, and you're navigating, and at the same time you're earning money on your money. It becomes like playing video games for a living, which is much more fun than going to sit at a corporate office. Now, I've seen on that vein, I've seen some similar applications for kids where it's a learn to earn. So you want to effectively, how it works is you kind of get 10 maths questions right in a row, and then you start earning tokens. And then the tokens are actually spendable for other items inside video games and stuff like that. And it's real money. I mean, it's real money. It's you learn to earn. You work to earn. You play to work and play to earn. You know, one of the most things that I love the most about DeFi is the fact that I could see my money growing. I don't know if you've ever staked before, but it's like a very small nuance. But what they do is they show you your money going up in real time.
It's very clever, and it's like they'll show you your money going up in increments that actually they're not spendable, but it's an amazing psychological effect because you see your money growing, even if it's at an increment that you couldn't draw out in 1 cent. It's very, very smart.
It's like going to a casino.
I think you bang on.
It's like going to a casino. The lighting is correct. The atmosphere is correct. They're appealing to your dopamine sensors and to all the other sensors that you want. Now, banking missed that. Banking said, hey, you put your money in the account here, you get 3% per annum, and then they send you a statement every month, which comes in a Chase envelope, and the banking fees are more than the thing. Now, banking missed the fun element. Making money is fun. The reason why I love crypto so much is because the experience of making money in crypto is actually a shitload of fun. And it's becoming more and more and more and more fun. And I think that the future is going to be a merger of games and DeFi, and it's going to actually be fun. You're going to live this double life, one real life here in the real world, and one life in this virtual making money world where you're going to play to earn for your customers.
Yeah, it's fascinating. I think you bang on. I think that sort of traditional finance have missed a trick, and I think it's too late now. It's too late for them to do it. You know, the banks have been watching money going out of the bank accounts into crypto accounts for a long time, and their first response was like, let's just unbank these people, let's debank them. Then they sort of realized, hold on, we can actually do the same thing. So now you're seeing banks like Commonwealth Bank of Australia suddenly saying, hey, actually, we're not going to debank you. Now we're actually going to let you buy crypto inside of your app. But I think it was Kai Sheffield, the crypto lead from Visa, where he said before they were sort of watching money going out of the banks and then punishing people. Now they're watching money flowing out of the banks and they're going, shit, is this going to come back? I don't think this money's going to come back. I think the money's going out, and I think it's staying out. And it's almost like banks are, I mean, look, we're very early. I'm not going to make a sweeping statement about banks because I just don't have the data, but it's kind of the early stages of banks being the kind of fiat on-ramp into crypto, which is not good for the banks because they make the money on lending, right? So super interesting to see what happens. I want to start wrapping up.
Just quickly before,
go for it.
You know, if you want to know which businesses are going to be disrupted next in the world, always look at the businesses that are most protected by legislation. So if you think about banking and the need for banking licenses and the bureaucracy that comes with banking licenses, they are protected by legislation. And so businesses traditionally that are protected by legislation generally become obsolete very quickly. Mobile phone networks are protected very much by legislation. Do you have a license? Don't you have a license? Do you have a 5G? But now they're being disrupted by peer-to-peer applications like Helium, for example. Yeah. So for me, the ones that are most protected by legislation are the ones that are most becoming obsolete the quickest, and they're going to be disrupted the hardest. But it's hard to disrupt them because you have to find kinks in the legislation that allow you to operate in the sphere in which they currently control.
Yeah, it's super fascinating to watch, and I mean, you've been in it for long enough, coming from a traditional background as well. It must be awesome for you to be so much in the thick of this and seeing this from every single angle. And I love watching your content and learning and just kind of I'm in awe at the amount of content you actually are able to consume and then put out on a daily basis. On that note, I want to start wrapping up because I know you've got to record a show, probably your 5th one for today. So just very quickly, not in detail, just predictions for 2022, not on prices. I resist the temptation to give me price predictions, but give me some predictions on, let's just go through those sort of topics. So predictions on what's going to happen in 2022 in traditional DeFi, NFTs, and play to earn. What do you think we're going to see in 2022?
So we've seen, let's talk about NFTs first. We've seen V1 of NFTs. V1 of NFTs is buying fancy JPEGs and being part of a club. So if I'm a punk, I'm part of the punks club because if I own an Ether Rock, I'm part of the Ether Rock club. And it is people looking for a sense of society and acceptance that is disconnected from their geographical society. So not only am I South African, but actually, I'm a punk. So if you think about a hierarchy, if I say to you, Mike, who are you? Your initial answer will be, well, I'm male, and then I'm wherever you're from, and then I'm whatever religion. That's kind of like if I were to ask you how to define yourself, you would define it in those three first, right? So, or I'm married or whatever. Now, people are looking for a sense of acceptance in other places, and NFTs have provided that. So we've seen generation 1 of NFTs, which is play to earn in a very basic format, and people buying fancy JPEGs to be part of clubs. I think that the NFT completely evolves, and I think that everything that we do will be in an NFT. I think your identity will be one NFT, which you will choose to share certain parts of your NFT with people so that you have a record of who's accessed your NFT. And you will be able to sell your data to people if you want. So, for example, you may make, if you're looking for a car, you may make your NFT, which is enriched with all your data. And that's all your data, what you surf, what you buy, how often you drive, how fast you drive. You will make that available to people who will pitch you cars based on your data and pay you to use your data. So you'd be paid so I'm just giving you some examples of what NFT generation 2 looks like. And I think in 2022, we see NFT generation 2 starting to happen.
Self-sovereign identity. So like you're describing like a self-sovereign identity thing there within the NFT world, right? Yeah. Okay. Got it.
I think
cool. What else?
That 2022 is the year of a digital identity that is decentralized. So I think in 2022 we all get a digital or the birth of a digital identity card happens, where you have a digital identity which is actually not stored anywhere. It's stored on it's sharded and stored on multiple servers. So I think that happens too. I think 2022 is the year where we resolve all our layer 1 issues and we start getting very fast blockchains that are churning out multiple transactions and ready to go mainstream. Now, right now that doesn't exist. You've got Ethereum, which is building ETH 2.0. You've got Solana, which keeps crashing because it's on mainnet. You've got Avalanche, which keeps getting expensive every time because the virtue of its design gets expensive every time that multiple transactions come on. So I think we solved that in 2022, at the end of 2022. I think 2022 is the year that
that's huge. Yeah. I mean, that's massive. And by the way, Ran, I know you know this. It's not called ETH 2.0 anymore. What are they calling it now? Vitalik came out and he said it's not ETH 1 and ETH 2. He's got another name for it now. It's like ETH, I don't know, attestation and ETH transactions or something. Didn't you see that?
I'm
sure you'll see it today.
I think I heard something about it, but I mean, it's for us, it's ETH 2.0.
It's ETH 2.
I think we get institutional players. I think we get the rails and the foundations for institutional layers coming into DeFi. And I think because 2022 is going to be a very hard year on the markets, we're going to get some of the early adopters actually jumping in and going, we can't generate real returns on the markets. There's no real returns on bond yields. Let's just have a dip into this thing called institutional DeFi. I think 2022 is also a year of privacy. So privacy on the blockchain hasn't been a big issue. It's been a small issue. And I think 2022 is a year where privacy on the blockchain becomes a massive, massive, massive thing. And, privacy is not only about dealing drugs, so to speak. Like or buying illicit things. Privacy is when Walmart want to buy something from a Chinese company and they want to pay them and use blockchain money to pay them and store the asset records on blockchain, that no one has an idea of that it's Walmart and how much they're paying per item and where they're buying it from. And that's why companies need privacy. So I think that 2022 is a year of blockchain privacy. And I think and
we're actually seeing that. We're actually seeing that. There's a guy that I'm speaking to soon that's building something called the Panther protocol, and I think that's what they're doing.
Yeah.
And then of course there's Secret.
Yeah.
And then of course there's Secret, right? Secret, which I think you actually had them on your show. Smart guys, super smart guys at Secret. Yeah, cool. Go on. Super
there's
interesting.
Secret. There's Oasis Labs. There is a very cool protocol in Ethereum called Tornado Cash. And let me tell you why that's so important. So the notion of using blockchain money to pay for something is incredible because you get immediate settlement, because you're not beholden to the governments and it doesn't go through the banking systems. But it's also the dumbest thing that you can do. And I'll explain to you why. If you're a barista and you serve me a cup of coffee at Starbucks, and I pay you in Ethereum, because everything is transparent, you know what my Ethereum wallet is. And if you know what my Ethereum wallet is, you can see every single transaction that I've ever made and how much money is in my wallet. Okay, so what you say to yourself is, no. What I'm going to do is I'm going to start a second wallet and a third wallet, and my first wallet is my savings account, and my second wallet is the one that I pay for coffees with. The problem is that Ethereum has a design flaw or a design feature, depending on which side of the fence you're at. But in order to make a transaction, you need to pay for the transaction using Ethereum. So you have to fund it from somewhere.
Which means you can just keep doing
where was it funded from? Well, then that's Mike's other wallet. And then that's Mike's other wallet. And so we can't have an economy where every single transaction is completely visible to everyone, because it's not safe. If you think about building Uber, a decentralized ride-sharing service on the blockchain, which is a great idea. The only problem is that when you order the Uber, everyone will know where the hell you ordered it from.
Yeah.
Scary stuff.
And I actually spoke to a really, really smart guy in the States a while ago, not on the show, it was just a super interesting guy. And he's had a massively successful exit. And this is now what he's doing with his sort of his time and his resources is he reckons that they've basically got software now that can do forensic auditing on Bitcoin transactions where they can get pretty damn close to figuring out who's doing what when they need to. So they're working with certain governments, etc. And it's to your point, So when it's nefarious, it's great. But to your point, if you just want to buy a coffee at Starbucks and you happen to be a high net worth individual, you don't want the whole world to know that, hey, that guy's actually worth hundreds of millions of dollars. Now he's got a target on his back. So I hear you, and it's this is going to be a big issue because we're going to have the people saying, oh, but we need we need the transparency, and anyway, we won't go down that rabbit hole. Ran, conscious of time.
One more before we go.
Give me one more.
Decentralized social media. 2022 is the year. Decentralized social media. I think people are very tired of Facebook's censorship policies and Twitter's censorship policies, accounts getting deplatformed on YouTube, on Twitter, a sitting president getting deplatformed on Twitter, not being allowed to post jokes about COVID or anything about COVID at the risk of your account being deplatformed. I think people are fed up. I think people want the truth. And I think they're going to start finding it in blockchain. And I predict that in 2022, we'll see the first blockchain social media protocol to actually start gaining network effects.
I know you always talk about the guys at BBS, BSB, BSS. What are they called? BBS. You always talk about them.
They're one of our bets.
Seems like they are
one of our bets.
Yeah.
But I mean, you never know. Decentralized social, also a bet. Deso, they built BitClout.
BitClout, yeah.
So we've taken multiple bets. Privacy, layer ones, NFTs, learn. The biggest narrative, learn to earn. Learn to earn. Kids, learn to earn. Not play to earn. Play to learn to earn. That's a big narrative for me.
Interesting. Ran, we're going to wrap it up there. Thank you so much, dude. I know you're super busy. Thanks for putting out all the content. I mean, it's free, guys. This guy's really, really easy to find. Just Google Crypto Man Ran or Crypto Banter. You will see him everywhere. Look, so much value. I've taken so much, Ran. Thanks so much for the time. Appreciate you making the time. And we'll see you again in a few months, I'm sure.
Thanks a lot, Mike. Nice to see you again, man.
Cool. And to the listeners, I hope you got some value. I mean, I got tons. I hope you did. And I hope you've got a whole bunch of stuff that you can Google and research. Just be very careful if you're going to jump into any of these things. This was not financial advice in any way. If you would like to discuss your fintech or blockchain project with us, you're welcome to book a call with one of our principals. Just head over to www.nona.digital. And I'll be back next week with another episode to explore the Fintech Founder Journey.